Welcome back, friends, to the Global Macro Desk. Today, let's begin with some updates, and then we're going to talk about yield curves, gasoline futures, and recessions. So, uh, over the last 2 weeks, I had what you would call a hyper productive time. So now our investment universe is out to 1,900 financial instruments, 1,000 plus US stocks, over 750 Canadian stocks, 100 major ETFs, commodity futures, and global equity indices. And this is great news. And because we've added commodity futures, we can start talking about some macro related things, which is going to be very exciting. So, in terms of the game engine and the backtesting engine, now we can simulate virtually any performance and risk metric. So far, I've added Sharpe ratio, skew, kurtosis, max drawdown, realized vol, Kalmar ratio. Um, and this is just to test it out. I'll be adding or subtracting things depending on how things look going forward. But you'll see what I mean when I say we can simulate any performance or risk metric. The second thing is now we can simulate arbitrary signals. Uh, so instead of just the pipeline being the game engine generates signals and then we test those signals in the back testing engine. Now you can take basically any signal, whether it's macro, technical, fundamental, whatever, quantitative, statistical, whatever it is that you want, we can now simulate. And so, since we can do this, we can start talking about, okay, yield curves and, you know, commodity futures and all manner of macro variables, which is going to be interesting going forward because I think we are at an interesting point in terms of the economic cycle. So, and the other thing, number three, that's been updated is the TUI app is now feature complete. Like everything that I needed to code, all the functionality is done, but the UI is still pending. I'm using Prompt Toolkit to make this work, so it's taking a bit of extra time. Like it took me 2 weeks to get this far. I think I've added like 15,000 lines of code, and I've lost 10 pounds in the process as well. Like it was a massive sprint. So TUI app is up to date. Hopefully soon we can start getting into it. But today, let's talk about yield curves and gasoline futures and what I think is happening in the financial economy, real economy as well. But before that, we should be talking about macro signals. All right, so now that we can start simulating and modeling some macro trades or macro data, I'd like to talk about what I think, how I think about macro trading or macro signals, macro views, right? And so it boils down to this. A macro trade is basically composed of two parts. You have a thesis and then you have your expression. Your thesis is whatever your model, like it's synonymous with your model, your view, your signal, whatever it is that's giving you an idea of what to do or what to expect. Your expression, however, is how do you express that view? Right. So if you're just trading stocks, let's say you have an opinion, like whatever your model's telling you. Let's say Microsoft, you think it's going to be a great company, it has a bright future, and the only thing it can do is go up. Well, to express that particular view in while just trading stocks, I think there's only a handful of things you can do. You can buy Microsoft stock, you can buy call options, maybe you can buy Microsoft bonds, right? But beyond that, like the expression, how you execute on your thesis, you only have a handful of things to do. But when it comes to macro trading, your thesis could be something like, I think interest rates are going to go up. to express this particular idea into a set of trades or into a portfolio, like you have hundreds of options. You could be saying, oh, you can express it via trading the equity index, trading equity futures, trading at sector levels. You could be like, oh, well, tech stocks are going to have a bad time, or you could be, talking about utilities. You could be trading bonds, bond futures, interest rate derivatives. You could be trading commodities like real estate. The list just goes on and on. But the thing is that both are equally important. And I think the expression of the trade is even more important than the thesis, because sometimes what ends up happening is your thesis could be wrong, but your trade actually still ends up making money, right? But ideally, you want a thesis that is correct, and the expression of that thesis also makes money. Because I'm only mentioning this because a few years ago, like this was a problem. Like I did have a bad time because like I had a thesis. It was 100% correct. Everything that I expected to happen happened exactly 100% correct. But my expression was 100% wrong, and it was fucking disastrous, right? So, um, finding ways to express the trade in an intelligent manner, in a simple manner, is just as important as your whatever you think is going to be happening in the world, whatever your model is. Um, so we need to begin with one very simple idea, right? Because now that we're talking about yield curves, the latest news over the last couple of weeks or last week or so has been, uh, the U.S. yield curve, the 10-2, has uninverted, and there's so much chatter on YouTube, like it's the end of the world is coming, chatter on Twitter, investment banks are releasing report after report. Um, so we need to sort of sharpen the discussion and see exactly what all of this adds up to. Like what exactly does it mean for the economy, or for the S&P 500, for when yield curve inverts or uninverts. So we can't buy or sell recessions, right? Uh, we can't buy or sell geopolitical events either. Like you can't go to your broker and be like, I need 10 shares of the recession coming up, or I need 10 shares of the civil war that's breaking out somewhere, right? We can only buy financial instruments. So, and we can only speculate via financial instruments based on our signal or our view or a model or a thesis, whatever it is that you want to call it. Um, and we need to be able to quantify our signal. We need to be able to map our signal to a financial instrument. We have to be able to map our signal's performance over our entire trading horizon. For us, our trading horizon is almost always 1 year out, right? So for me, it's September 2024 right now. I'm mostly concerned with what will the portfolio look like by September 2025? What will this next trade look like by September 2025? In October 2024, I'll be thinking about what October 2025 is going to look like, right? So um, we need to figure out what it means for the S&P 500, let's say about 1 year out, what it means for the S&P 500 when the yield curve inverts or uninverts. For us, we're going to be talking about uninverts because that's what's happened. We're going to be looking at two spreads, the 10-2 and the 10-year and federal funds. The 10-2 goes back to, I believe, the late 70s. I've added the 10-year and the federal fund spread because that data actually goes back to the 1960s. So we have more data to play with. Uh, we can do a more interesting analysis. Well, we will be doing a more interesting analysis, right? So let's just look at, this is data from the Federal Reserve, and we can see, like visually, if you look at this, you can see that when when the yield curve uninverts, right? Or inverts, becomes negative, um, shortly after, you do have a recessionary period. And it's especially true when it uninverts, right? So the yield curve uninverted in just before 2020, before 2008, before 2000, before 1990, in the 80s, in the 70s. And so, well, the thing is, this doesn't mean anything, right? Like, once again, you can't buy or sell recessions. Like, just because a recession is coming, like, you have to map these onto a financial instrument. For us, it's going to be the S&P 500, but it could be anything. It'd be commodity futures, it could be commodity indices, bond indices, like whatever it is, you have to map it to something that you can trade. So our main question is, what happens to the S&P 500 when the yield curve uninverts, right? And then the picture is even more interesting if you look at the 10-year 10-year versus federal funds, right? This data goes back to, I guess, the early 60s, right? And you can see that this inversion and uninversion process happens quite a bit, but visually you can sort of see that, oh, okay, that's sort of saying that the recessionary period is coming, right? But looking at a chart like this can be very costly if you don't break down the numbers. So let us try to break down some numbers, right? So we're going to be looking at the 10-year. Right? So the 10-2. So um, the bottom chart shows you every single time the yield curve uninverted historically uh, for the 10 and 2. Right, and I've marked it with the red dots. You've seen these charts before, right? And it sort of looks like, well, yeah, it looks like whenever this signal or whenever this signal occurs, something bad happens to the stock market shortly after. You can see visually, right? Your eyes aren't lying to you. Um, and this is just a regular scale. The top chart is the log scale, right? And you can even see here, you can see 2020, um, you can see what's happening right now. You can see 2008, you can see 2000, the 90s, the 80s, right? But then if you look at 1 year forward, right, your median return for the S&P 500 is still 13%. Your worst case return, your 1 percentile return is a minus 15, and your 99th percentile return is a 50%. Over a 1 year horizon, over 9 months, your worst case is a minus 25, your median case is a 5.8. The interesting thing here is that once this signal actually hits, right, once the yield curve uninverts, for the first 9 months, basically, month one, month two, month three, month six, and month nine, your returns are basically close to zero, right? You just have this massive chop that's going on, at least in the median. But just looking at this chart shows you that the picture isn't as clear as Twitter or all these social media make it out to seem that as soon as the yield curve uninverts, that means that you have to sell all your stocks or you have to start buying put options. No, 1 year out, your median return is still a 13%, right? Your distribution, these are your distribution of returns 6 months out and 12 months out. And you can see that, yes, there is a left tail, but there's also a right tail. So you could also, like, 1 year out, the market could still be higher than it is today. It could be lower than it is today, or it could be significantly higher than it is today. Right? It's not a clear-cut picture. It's not a clear-cut signal. Um, we can look at the cumulative return paths. This is your median path, right? And you can see there's this massive spread, plus 50%, minus 20%, right? Minus 15%. And so now the picture isn't as clear as when we were looking at when we were looking up here, when we're looking at the Fred chart, right? Yes, a recession will come whenever these yield curves invert and uninvert shortly after there's a recession, but 1 year out, the picture isn't as clear as many make it out to seem, right? And this is important because this affects your P&L, it affects your trading, it affects your cumulative returns, it affects your portfolio. You can't just, make decisions based on a chart. You need to map your view, your signal onto onto a financial instrument. You need to back up. You need to pull back. You need to pull out the data and see exactly, what you're dealing with. And here, it's not a very clear picture, right? So uh, these are, I think, for the 10 and 2, there's, I think, a little over 40 times when the yield curve is uninverted since the 70s. And this is what happened to the S&P every single time 1 year out, right? And so basically, you can see that there's sort of three buckets you're dealing with. You're dealing with this bucket at the bottom end, right? Minus 15, minus 20%. You're dealing with a bucket that's somewhere around a 20%. And you're dealing with a bucket that's somewhere like a 40 or 50%, right? So the picture isn't clear. So this tells you that you need some more data. But um, uh, what it also doesn't say is that um, uh, go sell the S&P 500 or go buy the S&P 500. You need to sort of think a little bit deeper on what to do, right? And now we can look at probabilities, right? What's the probability at any horizon that your P&L is going to be greater than zero? And then initially you can see that probabilities are pretty low, like it's a coin flip, and then it rises up to like a 73%. And your expected path, your median path is also up to basically May 2025. You're sort of just flat, and you're expecting a flat return. Obviously, the actual return it's not going to be exactly this line, but your expectation is something like a flat return, and then it accelerates out, right? In terms of your Sharp, what Sharp can you expect on any of these horizons? Initially, you have a Sharp that's basically negative, it's falling, and then over time it sort of pulls up to near your median Sharp pulls up to like a 0.994. But the thing is, even the Sharp has a distribution, right? The Sharp ratio here has a distribution. It's like you can have scenarios where um, if you were to buy the S&P 500, you get a Sharp of like a 3 or 4, or a Sharp of a minus, a -1 or minus half. So um, it's not as clear as we would like it to be. And for median, we can look at median realized vol as well. And you can see that as your trading horizon increases, your median vol is also increasing, right? So your uncertainty to some extent is also increasing. But the median volatility itself has a distribution. So you can have crazy paths, right? Um, but overall, you're expecting to fall somewhere between these two extremes. Your median drawdown, this is far more interesting, is that your median drawdown is sort of something like a -16%, right? But your 1 percentile drawdown is something like a -35%. So you can expect that your drawdown, if you were to take this trade tomorrow, will be somewhere between these extremes. We can look at the skew as well. Initially, for the most of the life of this trade, you're expecting a negative skew, and then it pops up just a little bit to a positive, and then it keeps falling back. But the skew itself has a distribution. Kurtosis, same thing, but kurtosis is above zero. So as your horizon is increasing, right, your tails are getting fatter more or less, and you can have some crazy kurtosis numbers as well. The Kalmar ratio is basically below 1 for the life of the trade, for the life of your entire horizon. So, uh, what happens if uh, what happens to the S&P 500 when the 10-2s uninvert? Well, many things can happen, right? You have three options to sort of choose from based on historic data. You have a negative outcome, you have a positive outcome, and then you have a wildly positive outcome. So, is this enough data for us to make a decision? That's up to you. It's not enough data for me. Let's take a look at federal funds. Right? And this is far like this. I found this to be more interesting because like there was more data available. So the spread between the 10-year and federal funds is I think there's over 220 points, like 222 points, and only 217 were included in this back test. The missing points were because the data wasn't aligning up, and that's something I'm gonna have to I'll have to make some fixes very soon. The thing is, when you have like many data sources, just trying to get data to line up is a task in itself. It's a project in itself. Right? But here, this is every single time the the 10-year and federal fund spread um, went from a negative number to a positive number, right? So it was a negative number yesterday, and it's a positive number today. And we have, I think, 217 instances. The 60s were a pretty wild time. And you can see the 70s were also a pretty wild time. 80s were a wild time, right? So we see the chart, but now it's become even more unclear, right? Because you see these inversions and uninversions happening back to back to back, but the stock market is just flying along. There's some instances where the signal, uh, the yield curve uninverts, and then shortly after you have a crash. Same thing in 2020, right? So you can expect that the story is even more muddled than just a 10 and 2, right? So for here, your median expected return is a 16%. Your 1 percentile return is basically a minus 40, and then your 99th percentile return is a 54%, let's say a 55%. At 6 months, you have this bimodal distribution, right? You have peaks at, on both sides of zero. So you can have a positive return or a negative return. It'll fall somewhere there. But if you extend your horizon out to 12 months out, uh, the peak of your distribution is hovering around 20%, but then you have this long left and thick tail on the left, right? So you want to talk about uncertainty, you want to talk about is this a clear signal? This is all you need to look at, and you're like, oh, well, it's not as clear as we would want it to be, we would like it to be. Same thing with the cumulative return paths, right? You have this massive spread, right, between today and a year out. If you were to use the yield curve on inversion as a signal, you basically have this massive distribution that ranges from like a minus 40 to a plus 50, and you sort of have to do something with it, right? It's and the median is sitting somewhere at a minus at a plus 16%. So you can take this trade and things might just work out, or you can take this trade and things just don't work out. You end up, you very shortly we could have a recession, and then stocks crash 50%. But this isn't enough to say that, oh, let's make portfolio altering decisions, right? Now, these are all the 217 instances, and you can see you have this massive distribution, right? All the way from minus 40 up to plus 60, basically, right? And you'll fall somewhere within this distribution, right? Worst case scenario, a scenario that might not be accounted for is that the sample path you follow is something that's completely brand new. And that's something to understand about empirical distributions as well, right? Because I guess Taleb would say something like the empirical distribution is not empirical, right? And the point of that is that like to know the true distribution that let's say the market is going to generate or is generating, like you need an insane amount of data, right? Like we haven't had markets trading long enough to generate the data for what we could like estimate for to be a true distribution. So there are many things that have happened yesterday, right, that will more or less happen tomorrow. But there are some things that will happen tomorrow that have never happened before, right? So, uh, but this is the best we can do, right? Uh, this is what the historical data is saying. Beyond this, you can only you're only adding something of your own. You're adding your own view, you're adding your own bias, you're adding your own model, you're adding your own quantitative analysis, like whatever it is. Beyond this, that's something you're adding. That's not something the market is telling you, right? So for us, um, is this a good trade to make when you have a distribution like this? Is this something that you'd be comfortable um, um, uh, making a large bet on? I wouldn't be very comfortable, right? So it's probably best not to listen to Jim Cramer or investment banking research or Twitter personalities or Reddit personalities or people on YouTube crying about uh, a crash that's coming. A crash might just come, actually. I believe that we're at a critical juncture, but these data points don't tell you what you think they tell you, right? That was the whole point of this video, to show you that what the yield curve, like what we think the yield curve is saying, or what people say think the yield curve is saying, is not what it's actually saying. Like when you map it onto a trade, when you map it onto the S&P 500, right? Like it could be that we have a glorious year from today, right? And we do a full plus 60% from today, right? Or it could literally be that we have a terrible fucking time going forward. And a year from today, September 2025, the S&P is down 40%. And we're all, you know, crying. But that's the discussion about the yield curve. So, it's important to make sure that when you're thinking about these things, that you map them onto financial instruments and actually look at the data and see what the data is actually saying, as opposed to, just looking at charts and being misled. Don't be misled. I don't want to be misled. But the most important signal that we actually got was on the 12th. That was for gasoline futures, right? Now, gasoline futures are pretty fucking interesting, right? And this signal is very interesting. So the game engine produced a signal on the 12th, and it's worth talking about because this signal in itself is super interesting, right? So you can see visually, right, that this signal either catches the bottom, like in these instances, right? It catches the bottom. It signals a true bottom, and gasoline futures, RBOB futures, just pop up shortly after, right? Or it signals that we're at a bottom, but it's an early signal, and then it eventually finds the bottom. And those instances are like 2008, 2015, that was a commodity crash, 2020, and even the 2000s, right? All crisis periods, right? So if you look at this signal, this is a clear picture, right? You have instances where it catches the bottom, right? Here it caught the bottom, caught the bottom. And then the second scenario is that it catches the bottom early. Eventually, it catches the bottom, and that's a crisis period. So what you actually have here is something that looks like a binary outcome. Either um, gasoline futures, by extension, the crude oil market in general, from today will halve, right? We're looking at a 50% crash, or we're at a we're at a true bottom, and oil prices will rebound, and gasoline prices will rebound as well, right? And you can see that your median return is a 31%. And visually, you should be able to pick this out, right? Um, your worst case return, your one percentile return is a minus 40%, and this is when you catch it early, right? You catch it too early, but eventually you catch the true bottom. And your 99th percentile return is like a 280%, right? Now, what this signals for uh, the economy, right? Like if I had to read a little bit into this, um, to me, right, when you start getting signals like macro signals for oil or any of these energy commodities, gasoline and oil, it's that there's a problem going on in the real economy, right? There's most likely it's not a supply problem, right? These prices aren't falling because Saudi Arabia and the United States and Venezuela, Nigeria, Canada are pumping out too much oil or they're making too much gasoline. It's probably a demand issue, right? It's a consumption problem. There's been a fall in the demand of oil. This is just me. I haven't looked any of this up. This is me just reading into what I'm seeing, right? Reading into this signal. So that means we're basically at a binary outcome, meaning that we are at something that feels like a critical juncture, right? That either we're going into a recession, right? And that's literally what this signal is saying. Either we're going into recession or the worst of it has is behind us and we're just gonna rebound. Now we have two signals sort of happening simultaneously, right? We have the yield curve uninverting, right? We have this oil signal happening basically simultaneously, and so that should give you pause. You should like that gives me pause. That are we heading into something a little dangerous? Or are we heading into dangerous territory? Because a recession is possible, right? And based on just this signal alone, it's something that feels close to a coin flip, right? Either we go into a deep recession, or we go into a recession, or we just rebound from here and then everything is fine. Um, Now, I've seen arguments for why we should be going into recession. I've seen arguments for, you know, um, uh, how all this needs to, like how everything's going to play out. That, the government debt is so high, the demand is falling, interest rates are too high, people just don't have, there's an inflation problem, X, Y, Z. But on the flip side, right, I also think that those two or three dozen facilities that the Federal Reserve opened in 2020. Yeah, those still exist, right? Every swap line with every central bank is already it's already it's already uh, it's already open, right? So um, the U.S. federal government is spending. I think that the deficit is like 7% of GDP. A lot of money is going into the economy. So the usual mechanisms of crises that we've been used to since 2008, 2000, 1998, 97, basically every kind of crisis that we've seen, right? It's generally been, something like it's a credit problem. It's a liquidity problem. There's a dollar shortage somewhere, and that causes a cascade. Right? It's sort of basically the same kinds of things that happen over and over again. But this time around, like today, right, I have this feeling. I haven't done enough research on this, but I have this feeling that if we go into a deep recession, right, it will be something completely brand new, something that the Federal Reserve hasn't accounted for. Because like I feel that if times get really bad, the Federal Reserve will start start up the printer again. Anyone that's short on dollars, that's short on liquidity, will get the liquidity they need. Primary dealers uh, will be flush with cash. Um, the U.S. government will step in if it needs to. Um, uh, so can we have a deep recession? Sure, we can have a deep recession, but I just think that today, uh, like something big has to happen, something new, something we're not completely aware of, something that the the authorities, the Federal Reserve isn't completely aware of. And this is just me speculating. This is just me thinking out loud. But it's just it's just difficult to think that, you could go into a deep recession um, with the way the world is at the moment, right? With the way government finances are working, with the way, you know, the MMT policies that we're seeing in the world today. Um, but I could be wrong. I'm just thinking out loud here. We could have a light recession, something that sort of just passes us by. Maybe the S&P does a minus 20%, something like that, or a minus 10%, like something that we just brush past, and that's okay. Or we could have, you know, or we're just worried. Uh, at least we're too worried about the future, right? At least for a 1 year out horizon. For the time being, I think uh, this is something to ponder on. Like this is something to think about. It's something to have on your radar. When you start having multiple signals sort of saying the same thing or sort of hinting at the risk of calamity, over the horizon, it's something to, you know, keep, it's something to constantly think about. It's something to be aware of. And today we have this gasoline signal, which is extremely interesting. Um, I think I'll have some more to say on this relatively soon. For the time being, I just finished coding this out, and I was pretty excited just to show this off and start working on this, start making this part of the workflow. Um, but I think beyond this, uh, maybe it's time to be slightly more cautious. Maybe it's time to be slightly more observant of the world around us, right? But other than that, uh, thank you very much, friends. See you next time. Oh, speaking of next time, there has been now that we have like 1900 financial instruments that that are part of our investment universe. There are a lot of stock signals. So Thursday and Friday there was uh, a big chunk of stock signals that I sort of need to execute on. I think today, Monday. So I'll be doing that, and once I've executed on whatever trades look good, I'll be updating you guys on that, and that should be great. Thank you very much. Have a great day, guys.